This
are
conference will
working
now be recorded.
in both the residential and commercial space. Um, Looks like we're in the process of shifting over control of my slides to me, and we hopefully have them now. So what we'd like to talk about today from my part of the presentation before we turn it over to what I think will be a very, very interesting discussion on opportunity zones. So I'm going to try not to eat up all of the time or take all the oxygen out of the room. We can talk a little bit about what's going on in the U.S. economy because bottom line, as the economy goes, so goes commercial real estate. And I think it's important to see what's happening in terms of economic trends in order to kind of take a look in context at those commercial real estate sales. We'll take a look at a recap of 2018. Full disclosure, it is not a full recap of 2018 because the books really haven't yet been closed on the last month and a half of the year. This is something that will be updated, but we have really good data through Q3 and the beginning of Q4. We'll take a look at a couple of the segments that are of particular interest or doing something a little bit out of the ordinary or might be opportunities. And in at least one or two of those cases, I think there'll be a really good segue into the discussion on opportunity zones because the types of segments we're talking about lend themselves to the kind of investment opportunities that my counterpart will be speaking about later in the session. So that's what we're going to cover in my part of the discussion. We'll jump right in. Bottom line on the U.S. economy right now is it continues to hit on all cylinders. Now, I'm going to put a big asterisk and a caveat on everything I'm about to say because the degree of political uncertainty in D.C. and the ongoing trade talks with our major trading partners really makes a lot of forecasting very difficult to do precisely or accurately. But given where we are today in the economy, that's what we're going to talk about, and we're going to assume that the powers that be don't do anything historically stupid and get us into an unexpected recession. Gross domestic product, GDP, in the news all the time, and it continues its strong performance. Most recent numbers are somewhere in the neighborhood of 3.5 to 3.7% quarterly growth. That's a little bit better than historical averages, not a lot. The historical averages are somewhere between 3 and 3.5%. But we have seen a steady pace of candidly, unexpectedly strong GDP performance over the last few quarters. So the economy from a production standpoint continues to churn along in a pretty healthy manner. Most of the forecasts that I've seen for next year call for slightly weaker GDP growth. Nobody that I follow anyway is projecting negative growth next year. But looking at this criteria, again, it's the first sign of an economy that's doing particularly well. Doing better than expected is job creation, and in fact, most recent reports have been off the charts. There were 312,000 jobs created in the last report, monthly report, and the prior 2 months were adjusted upwards. We are at an unprecedented level of job creation, and there's a couple other sort of subtexts here that are even better news. The majority of these jobs being created are not the low wage paying or potentially temporary jobs that we saw during the early stages of the recovery from the Great Recession. There's a lot of manufacturing jobs. There's a growing number of construction jobs, which is certainly a good sign for both the commercial and residential real estate businesses. So these are jobs with decent salaries, decent wages. We'll get into that in a little bit. But the other thing to keep in mind at this point is that there are actually more available jobs in the country right now than there are workers looking for those jobs. This is an inflection point that doesn't happen terribly often. And in case you're wondering, you're going to ask the really obvious question. There's a disconnect at two levels that's preventing a sort of equilibrium. One is that a lot of the jobs that are available are in locations where there aren't a lot of available workers, so there's a geographic disconnect. And the other is that there's a skills disconnect, and the jobs that are available don't match up well with the skills of the people that are still looking for work, a lot of whom are at this point long-term unemployed. So the job numbers are very exciting, very strong. Not utopia, but pretty darn close from at least a jobs perspective. Unsurprisingly, perhaps, with all those jobs being created and the GDP as strong as it is, unemployment remains near its 49-year low. And again, putting that in perspective, these are the lowest unemployment rates we've had since, I believe, President Nixon was in office. So it's a really compelling recovery story that's been going on really now for the last 5 or 6 years, but it's picked up a lot of steam. Now, in case you're wondering, there was a slight uptick in unemployment last month. We went from 3.7% to 3.9%. To put that in perspective, full employment is considered to be somewhere between 4 and 5%. So we're still doing very, very well. One of the reasons that unemployment blipped up just a little bit is because more people came back into the job market, and that's a good sign. So what that means is the labor force participation rate is improving. And as more people came back into the job market looking for jobs, that's why we had a little bit of a blip in unemployment. So it's one of those things where what looks like bad news is actually something along the lines of good news. So the other thing that I'm not showing you today, but in terms of labor force participation rates, and that's simply the percentage of people who would like to work, who are actively looking for work or are currently engaged in some sort of job. The prime years, the 25 to 54 years, we've seen an even more dramatic lift in labor force participation rates, up around where we were during the last peak of the economic cycle. Where we're continuing to see a little bit of weakness is at the younger age bracket and the older age bracket. It does appear that we have more young adults staying in school longer. We have some older adults who are not working full time. Maybe they're taking early retirement. As the boomers age, this becomes more and more of a consideration. But it again looks, if you smooth these charts out, it looks like labor force participation is going in the right direction. What that means, by the way, from a commercial standpoint, is most of these are non-farm jobs. So these are jobs that are what the industry refers to as in place. That means there's more of a need for places to put these workers, or that means that there's been investment in places to put these workers. So these are all very, very positive aspects for commercial real estate sales trends. One thing to think about when you're looking at all the jobs is that the number of part-time workers, the percentage of workers who are working part-time, are still near their historic highs. In many cases during the early parts of the recovery, this was simply because people couldn't find full-time work. There was a particular spike in the number of part-time employees after the Affordable Health Care Act was enforced some years back, because a lot of employers at that point started capping employee hours at 30 a week, which meant they were under the requirement. They didn't meet the requirements that would have pushed them into the Affordable Health Care Act program. They were able to not give those benefits to employees. We've seen a little bit of that weaken over the last few years, but some of this is impacted also by the gig economy. You know, a lot of people doing driving for Uber and Lyft, doing Airbnb, doing other gig sorts of work that they use to augment their income. So the numbers are a little inflated from that perspective. But bottom line is a lot of people are working. As more and more folks work, we're starting to see wage growth improve and improve on a steady, consistent basis. If you look over the last 10 years, and it's really not fair to go much past 2010 because we were still in the teeth of the recession, but you had these spikes and drops, and what we've seen over the last few years is a pretty steady year-over-year increase, which is what you're really looking for, and wage growth has consistently been over 4% for the last few quarters. So again, wage growth looking good. Now, one of the downsides of wage growth is it adds to production costs, and so that could become a bit of a risk of inflation. But we're still seeing that inflation is relatively low, and the Federal Reserve is doing what it can to make sure that is the case. I don't have slides on this, but it does have implications for the commercial market in terms of both sales and pricing. The Fed has continued to raise rates. There's a lot of debate about whether we'll see 2 or 3 this year, but likely that we will continue to see some. Among other reasons, the Fed needs to do that just to give it some tools to use when we eventually get to another recession. But as those rates have gone up, as interest rates have risen, it's had an effect on compressing cap rates, so it's harder to get the kind of investment returns that a lot of investors are looking for. Again, one of the reasons the opportunity zone discussion is of such interest because of the potential returns there. But it is worth keeping an eye on the Fed to see what happens over the course of 2019 to see what kind of impact that has. In case you're wondering, this is a question I usually get, and we may not have time for it at the end. So most of the economists I talk to or follow are speculating that we will likely have a recession somewhere toward the end of this year or the beginning of next year. The most likely cause of the recession is that the Fed will overcorrect. And I'm in Southern California, where it took me a lot longer to get to the office than usual today because Southern Californians have no idea how to drive in the rain, and there were 2 accidents here. And the reason I'm bringing that to your attention is because that's sort of what happens with the Fed. They get on a slick road because the economy is percolating at a high rate. They hit the brakes a little bit too hard, and they kind of skid off to the side. And that's basically what the most likely scenario is for the next recession. By all of the forecasts I read, it's projected to be a relatively mild recession, nothing like what we went through the last time. But we're at the tail end of what's the longest economic growth cycle in history. So it's likely that sooner or later we're going to have to come to an end of that. So what happened in 2018? 2018 got off to a really, really rocky start. But the good news is toward the end of the year, we started to see things really come back to much more positive notes. I have a number of reports that I'm citing here. The 3 that I pull from the most are from my friends at 10X Research. 10X company I used to work at does an online platform for real estate sales. From the National Association of Realtors that has a particular expertise in small cap CRE deals. And then also from the Mortgage Bankers Association. So if I'm not referring to anybody on a particular slide, it's generally from one of those 3 reports. But as you can see in the overview here, as the year progressed, as we got through the end of 2018, we started to see much more steady growth. Deal volume across most of the segments was up year over year, all-time high in a couple of those areas. We're seeing a surprising bump in retail sales. So it's very likely that the rumored death of the retail market is probably a little bit over-exaggerated. But we saw a deal volume in the third quarter of about $144 billion. It was up almost 25% year over year, 25% from the second quarter, and 22% on a year over year basis. And it was a really good way to end what had started off as a somewhat problematic year. And if you look at what happened in 2018 on a quarter over quarter basis, and this chart goes through apartments, retail, industrial, and office. The only one it doesn't include is hotels. You can see that the numbers are very, very strong by historical standards as well. If you look at what's going on a segment by segment basis, you're seeing that the apartment and retail sectors are driving the growth. If you look at the breakout, office and apartment transactions represented about 59% of the deal volume. They were both up between 14 and 15% from last year. The retail numbers are kind of amazing. They went up by 90% on a year-over-year basis, almost $28 billion, which is the highest it's ever been. And it's kind of counterintuitive because we've seen all these big box stores announcing closings, and you hear about e-commerce taking over. But what we're seeing is a lot of M&A activity and a lot of purchase activity of malls that were either vacant or becoming vacant and are now being repurposed. And they're being used for mixed use. So you're seeing, in some cases, a combination of retail, office, and entertainment. You're even seeing some of them converted over into residential units, which is kind of amazing. I like to say that for my generation, I was at the tail end of the baby boomer generation. Our parents' comments might actually be coming true because when we were teenagers, we'd always go hang out at the mall. And I remember my mom saying, "Why don't you just go live there?" and maybe now these malls will be converted to senior living facilities, and we will live there, and it would just it would kind of come full circle if you look at it that way. Um, Office and retail pricing has outpaced other segments. Again, I think a little bit of a surprise given what we've seen in the office or in the retail market over the last couple of years. But bottom line is, outside of the industrial space, which is kind of flattened, all the other areas, hotels, offices, retail, even multifamily, have either been trickling up toward the end of the year or at least stabilizing. The industrial number is a little interesting because industrial is probably the hottest sector right now. We'll talk about that a little later. Um, but it may have hit a price peak and is working its way back down as more inventory comes to market. And again, no matter what index you look at, and this one goes through the RCA index, the National Council of Real Estate Investment Fiduciaries, and Green Street Advisors, we're seeing year-over-year increases in pricing. We're also seeing that both have significantly surpassed their prior peak. Major difference here, by the way, in these two charts is just the time series that's covered. So one covers things over a longer period of time than the other does. But you can see that all of them continue to do what every financial analyst will like to see, which is they're going up and to the right. And so again, really, no matter what part of the market you're looking at, you're continuing to see price increases in CREs. Now, it may be slowing down a little bit, and this shows again three of the indices, but shows you the year-over-year performance. So they're still growing, but they're growing at a lower pace. And what's interesting to me about this one, because so many of the realtors that I know that work in the CRE space, either part-time or as an occasional opportunity, we're seeing that the speed of growth in terms of sales prices is dropping a little bit more rapidly in the low cap area than it is in the 2.5 million and up area, and that's really the difference between the gray line and the orange line. So again, even though you see those indices pointing down, it's still showing growth just at a slower pace. I mentioned the impact the Fed is having on cap rates, and so as interest rates go up, we're seeing the spread between investment and the yield of the U.S. Treasury bond, the 10-year Treasury, compressing a little bit. As those interest rates go up, you see the spreads compress, and that just makes sense. We're also seeing that cap rates are still running below their 10-year averages. The dots over there are the 10-year averages, and this becomes an issue for people looking to invest in commercial real estate, and they invest, of course, based on returns and cap rates. And as those cap rates continue to struggle to reach prior levels, it takes a different kind of investment strategy to participate in a lot of these markets. And you see that the retail cap rate has jumped up a bit. If you look at it, it's in the middle of the column over there, and that the hotel cap rate is very, very high, but as we're going to get into in just a couple slides, hotels may be peaking right now, so worth a little bit of a deeper look. You do have slightly higher cap rates in the small cap markets, so if you're dealing with really the sales below $2.5 million, which really comprises the majority of overall commercial real estate sales, you see slightly higher cap rates, but there's slightly more risk involved. And that probably speaks to why those cap rates are a little bit higher. You might have more properties out in secondary and tertiary markets with better pricing, which also can drive cap rates up a little bit. So again, opportunities for your investors, particularly if you're a realtor working in those secondary and tertiary markets where there are bargains to be had. We have seen rents improve, and that's been a pretty consistent theme. Last time we really saw an appreciable dip was probably in 2008, and we've seen vacancy rates stabilize. They were going up a little bit, but we're still looking at vacancy rates that are near historic lows. The apartment vacancy rate was one we were following for a while, and these are from Reese. And apartment vacancies had dipped below 4% at one point, which was really as low as vacancy rates had ever gotten in the multifamily market. They're trending up a little bit right now. They're probably closer to 5 and sometimes approaching 6% as new inventory comes on the market. But still vacancy rates are very, very healthy across the board. Surprising that we haven't seen more of an increase in vacancy rates in retail, and depending on what happens with Sears and Kmart and some of the other big box players this year, we might see that number actually increase a little bit. Similar findings again in the small cap markets, where we're seeing relatively low vacancy rates across the board, whether it's apartment, office, hotel, industrial, or retail. And we're seeing that new construction and leasing volume, so basically absorption rates versus new construction, are running pretty close to each other. So we're not expecting to see any particular imbalance in construction versus absorption rates in the marketplace. A few more slides, then I'll be turning it over, and we'll have the opportunity zone talk. But just wanted to talk a little bit about a couple of these market segments. The multifamily market, just an outside observation, maybe getting close to peaking. We've seen rent prices struggle a little bit in some major metropolitan areas, most notably New York and San Francisco, which may have been a little bit overbuilt on the luxury side of the market. But what we've seen in year-over-year changes in the types of occupied housing units, we went through a long period of time where, because of the recession, because of the housing market meltdown, we were seeing enormous growth in renter-occupied housing units, and actually negative numbers in the number of owner-occupied units. We're now in a number of quarters where we've seen consecutively the reverse of that. We've seen a greater number of owner-occupied homes and lower numbers of renter-occupied homes. Now, the most recent quarter, we saw a very, very healthy growth in owner-occupied and a slight growth in renter-occupied. And that probably represents millennials finally moving out of mom and dad's basement and getting into their own homes, household formation. There is, we believe, a pent-up amount of household formation, but it's getting into the market much more gradually than anybody really has expected. But as the shift seems to be heading back toward owner-occupied housing units and less activity on the rent side, and depending on how much inventory is expected to come to market in your particular part of the world, might be something to take a look at in terms of at least the rent opportunity and the peak pricing for the properties that are being put on the market. And this basically goes toward the same thing. We're seeing moderate absorption rates. We're seeing a little bit of increase in that inventory. They're trending in similar directions, but you know, the absorption rate versus the inventory changes certainly worth keeping an eye on. And again, apartment and multifamily construction varies wildly from market to market. So these are national numbers, and you really need to pay attention to what's going on in your part of the world. Also worth taking a look at what's going on in the single-family rental space in your given market, because in markets like Phoenix, like Las Vegas, where we've seen a lot of single-family rental units, it's had an impact on what's been going on in the multifamily market as well. The industrial sector is continuing to grow. This is a third quarter share of deal volume. You can see that the West accounts for a disproportionate share of that, almost as much as any other two segments or two sections of the country combined. And if you look at the South and Southwest and West, it's a huge percentage, almost half of the market. Three key drivers for industrial is that e-commerce continues to grow rapidly. That creates a need for distribution and warehousing centers closer to the buyers. And the retailers are looking for places with reasonable cost structures. So you're seeing a little bit of pricing pressure there as some of these facilities are being built in lower cost areas. We're also seeing a lot of growth in data centers for cloud computing. You can thank your friends at Amazon for that through their web services. Also companies like Oracle and Google and Microsoft and IBM, all big tech names. And then there's a growth because of the need for facilities for growing, manufacturing, and distributing legalized cannabis products. And those are the three things that are really driving industrial growth right now. And you can see prices are growing in all regions, but they're still the lowest, relatively speaking, on a price per square foot of any of the major segments. And then the last market I wanted to just make a couple of comments on is the hotel market. And this, again, courtesy of my friends at 10X. We saw deal volume drop down a little bit in the third quarter. It's up a little bit from the prior year, but down pretty significantly on a quarter-over-quarter basis. It is likely we'll continue to see the valuation numbers go down a little bit. RevPAR numbers have gone down, which tends to drive valuation down. Occupancies have been dropping since they peaked a few years ago, and 10X believes this is a market that is beginning to contract a little bit. And we'll see, despite the fact that dollar value may have peaked, we're seeing a little bit less business use of hotels. This may be partly an Airbnb phenomenon. We're also seeing a little bit less foreign money coming in to visit the hotels. So if you have clients that are in the hotel space, again, this calls for a little bit more of a deep dive, because you're probably going to see slightly different performance in the luxury market compared to the limited service market. But overall, it does look like this may be one of the segments contracting. The only other comment I'd make before I turn it over is that we've talked a little bit about on the retail side. I wouldn't write off the retail sector, and this is particularly true if you're in a suburban area that has a struggling mall. Again, what we're seeing is very creative endeavors by investors who are coming in and buying groups of malls and converting them to limited use facilities, which apparently has some legs. So I've tried to cover as much as I can as quickly as I can. I will now turn the control back over to my friends at ARIA so we can get into the Opportunity Zone conversation.
Wow, Rick. Oh my God, that was amazing. You covered a lot. I like that, living at the mall concept. Wow, you're right. I was just cracking up when you were saying that. But anyway, thank you again, Rick. Thank you for all what you do for us at ARIA, and we deeply appreciate everything you do. But before too long, I know I want to get to the Q&As afterwards, but I wanted to introduce Byron Shahangan, and Byron's from Phoenix, and Kurt, I believe, has met him, and we're happy to have him here. I do need to go have a drink with him just to get know a little bit more. But before that, Byron, I wanted to thank you for coming on and doing this for us. A little bit about Byron. I believe he's the co-chair of the firm, and he's also really working on the Opportunity Zone, and he's agreed to sort of come and give us sort of what's going on in the industry. He represents a lot of investors and funds a lot of sponsors and developers in respect to the Opportunity Zone program. I think he's worked with a lot of property exchanges agreements and state entities and varieties of zones in permitting matters. So we're very happy to have him. Byron's from Snell and Welmer, and I think he's involved with the development committee there. But without further ado, I'd like to have Byron go ahead and give us his presentation.
Awesome. Thank you, and appreciate the nice warm introduction, and happy to grab a beverage with you at any point. The Opportunity Zone program is a really interesting and exciting one. There's been a lot of buzz about it, obviously. There's unfortunately, a lot of misinformation that's out there, and so hopefully we can clear up some of that here. It is an in-depth tax program, and so we're going to try to keep it high level, keep it moving quick, but give you guys as much information as possible about the program. The exciting part, and I'm trying to find out the best way to, let's see, move my slides here. Do I have controls yet? There we go. Perfect. So the exciting part's obviously the tax incentives. So we'll roll through them real quick and explain what they are. The first is if you incur a gain through that it works for the program, and you put it into an Opportunity Zone fund, you're going to have a temporary deferral of paying taxes on that gain until December 31st, 2026. And that's a date I want you to remember. December 31st, 2026 is when you'll realize the gain. And so in 2027 is when you're going to go ahead and pay taxes on that. So the first one, you got a nice little deferral. No matter when you invest into the fund, you don't pay taxes until December 31st, 2026 is when you realize those taxes. The next one is if you invest early enough that those initial capital gains that you put into the Opportunity Zone program, you get a partial reduction of the taxes that you owe on that, and it's up to 15%. We'll talk through how that's calculated in a little bit, but just keep in mind, up to 15% when you do go to pay taxes at the end of 2026 and into 2027. And then the last one is the new asset that the fund is invested in, as long as you hold that new asset for 10 years and a day, anytime past 10 years when you go to sell it, you'll have a full forgiveness on any additional capital gains. So what may be helpful is let's just walk through a deal scenario real quick. So you've got some Amazon stock, you bought it for $500,000 10 years ago, 5 years ago, whenever that was, and now it's worth $1.5 million. You've tripled it, you've done really well, and you think, okay, I've got some gains, I've got $1 million worth of gains, I'm going to go ahead and sell that, and I'm going to invest it into one of these Opportunity Zone funds that everybody's talking about. So what's going to happen? You do that today, when you won't have to pay taxes on those capital gains to incur that $1 million, and I chose a really easy, sort of simple number there. And as long if you invested it today, you then realize the gain December 31st, 2026 into 2027 is when you would end up paying taxes. You're gonna get a 15% reduction in your basis on those taxes. So you're only going to pay taxes on $850,000 worth of gain. And then as long as the fund can invest in any qualifying assets, let's say it invests in some land and builds an office building, as long as the fund holds that asset for 10 years, any time that it sells that asset, you'll never pay any taxes on your future gains. So let's say that $1 million that you invested turns into $3 million. Well, you'll never pay any taxes ever on the $2 million when you finally go to sell that asset. So that's the general gist of the program. One of the questions that we oftentimes get is, so what is a fund? And do I have to invest in a fund? The answer is yes, you have to invest in a fund. And a fund is just going to be an LLC or an LP. It's going to be a multi-member entity, and there's going to be some requirements, some certification requirements and things like that. But there are ways to set up captive funds, and so it doesn't necessarily have to be a third-party syndicated fund. It doesn't have to be the Goldman Sachs of the world, although we are working with them to set up funds. It can also be a smaller developer who's saying, hey, I want to do my own fund here. Important to note as well, we get this question a lot, is can I invest money that is not capital gains into this transaction? The answer is yes, but you need to understand that only capital gains receive favorable tax treatment. So new fresh equity receives the economic benefits of the deal, and we suspect almost every deal will have new fresh equity, but will also have capital gains. It's only the capital gains that receives the positive economic benefit or positive tax benefit. I want to be careful there. And that's going to flow down to the individual taxpayer. So in terms of eligible gains, the general gist is any capital gains are eligible, but if it's some other type of ordinary income, depreciation, recapture, inventory, those things are not going to receive the same treatment. It's really got to be capital gains. So in terms of timing, let's get into how the deals are going to work. You've got 180 days from the realization of your gain to invest it into the opportunity fund. And then the fund's going to have some requirements as to what they need to do next, but important to remember 180 days after realization of your gain to invest it. The IRS in their latest round of regs, and I should say their only round of regs that has come out thus far, gave a special rule for pass-through entities. So multi-member pass-through entities, it's really nice. The individual taxpayer can extend their period of time or hold their period of time for that 180 days until the end of their partnership tax year. And the reason that the IRS did this is because a lot of folks that are investing in hedge funds and things like that, those hedge funds are buying and selling throughout the year, and the individual investor doesn't know when the gain is achieved until the end of the partnership tax year when they get their K-1 statement that's saying you had this many gains, here's how it works. So either you can invest within 180 days of achieving the gain, Or if you're in a pass-through entity and you're a member of a pass-through entity, you can actually toll or extend till 180 days to the end of your partnership tax year. The basic gist here is you've got, as we talked through it, this applies to eligible taxpayers. It flows through to the taxpayer. It's got to be the sale or exchange of property to an unrelated person. You need to make your investment before December 31st, 2026, which that's also the date, remember, when you are going to realize your tax gain after your deferral. So you can't invest in the program after that date, but you can invest anytime before that date. And then, again, election is going to be made by the taxpayer. So with this, there was a really nice sort of downside protection that the IRS provided. And one of the things that they said is that on December 31st, 2026, when you go to pay your taxes, you're going to pay your taxes on the lesser of the amount of your deferred gain or the fair market value of your investment. So if we enter a down market in 2026, 2027, what everybody's going to do is they're going to get a new appraisal and determine what their investment is worth on that date. And if it's less than the money that they invested, the IRS is only going to require them to pay taxes on the current value. You're still going to get, remember we talked about that 15% reduction that some folks are going to be eligible if you get in early enough. You're still going to have that as well. So there are some things that are going to be in play to limit the amount of taxes that folks are going to have to pay when it comes time in December 31st, 2026. Now that 15% reduction that I was talking about, this slide describes how that's made up. So the IRS said if you invest 5 years before December 31st, 2026, then you get a 10% reduction in the eligible amount of taxes that you're going to have to pay. And if you invest 7 years, you get an extra 5% reduction, which amounts to a total of 15%. So the general gist of this, if you invest as a taxpayer, if you invest your money into an opportunity zone fund on or before December 31st, 2019, you get a 15% reduction when you go to pay taxes in 2026, 2027. And if you invest it by December 31st, 2021, you'll get a 10% reduction. So anytime after that, you don't receive any of the deductions, but you still receive the deferral and you still receive the full forgiveness at the end of the 10-year period. So this sort of describes the 10-year period. The IRS did come out in their round of regs with one change to things that said the fund has to sell its interest in the newly acquired and developed property by December 31st, 2047. So for most folks, that's not going to be an issue. We don't see that being a problem. But what is important to note, you're going to have a phantom income issue for all investors December 31st, 2026. Now, there are some products that are coming to market already that are being talked about in which lenders will allow individuals to collateralize their interest in the fund and take out a loan to pay taxes. There's also some other mechanisms that we think are going to be in place for folks, whether it's refinancing and things like that, to push money down to investors so that they can go ahead and pay their taxes that they're going to owe and have to pay in 2027. This slide just basically describes this sort of 5 and 10 year hold, getting that 15%, and then you've got to ultimately hold for 10 years to get the full forgiveness, which is what kind of is that pot of gold that everybody's looking for. One important thing to note, we talked about these 3 economic benefit or tax benefits that are available: the temporary deferral, the partial reduction in taxes owed, and then the full forgiveness. Most folks seem to be focusing on the full forgiveness, but important to note, one of the accounting groups we're working with has run some numbers and has said on a deal with a 6% IRR, there's actually a 3% bump in your IRR, bring it to a 9% IRR for just those first 2. So never mind the full forgiveness. So the tax benefits associated with just those first 2 are really significant. And then you add that to the full forgiveness, it becomes a really exciting incentive, I think. So this is an example. We kind of walked through something similar, but I feel like these can be really helpful. So we'll cruise through this one real quick. So investor sells some stock. And important to note in this program, unlike a 1031, which it seems like this program gets likened to a lot, in this instance, we don't have to sell like-kind property. So it doesn't have to be real property. It can be stock. It can be the sale of a business. It can be the sale of artwork, anything like that. There's no tracing of funds. You don't have to invest the full portion of your gain. You don't have to bring over your basis. So there's no boot issue. There's nothing like that. There's a lot of flexibility. You don't have to invest all of your gain in one fund. You can invest a gain from one sale into multiple funds. And similarly, you can just invest a portion of your gain into one fund. You can also have multiple gains that you compile together and put into one fund. But in this example, we've got it a little bit more straightforward. And the idea being, investors sell stock for $30 million. They've got $20 million in long-term capital gains, and that's in July 2018. Investor thinks, gosh, I want to get into one of these deals. They decided to take their $20 million, so they took their entire gain, but they left their basis, and they put it into the Opportunity Zone Fund. Keeping in mind, if they had invested the entire $30 million, only $20 million would receive the tax benefits, but all 30 would receive the economic benefits of the deal. December 31st, 2026 arrives, and they've got to make a tax payment, but because they were in early enough into the fund, they've got their 15% reduction, which amounts to $3 million, and so they pay on $17 million of long-term capital gains. Now, 2028 comes around, the fund says, great, we've had a good run, it's time to sell. Our $20 million investment now looks like $60 million. That $40 million that would have been eligible for capital gains is not taxed at all. You don't owe a single cent on it. So pretty awesome incentive here. So important to note, as the fund gets the money, the fund's got to do some things with the money. And that, as an individual investor, that's not as important. But for folks that are thinking through the program and thinking about setting up their own fund, it's important to note one of the biggest hurdles is going to be the substantial improvement hurdle. And that just means that whatever the property was purchased for, you've got to double your basis in it. So if you bought the property for $5 million, you've got to substantially improve it by $5 million. Now you have a 30-month period to do so on the basic legislative statute. And so in doing that, the legislators have outlined that the program is going to intend to be for the development of assets as opposed to just holding on to assets. So you've got 30 months to do so under the initial legislation, and some of that changed now that the new regs are out, but I'll get into that in a second. The basic gist of setting up a fund is they're going to be self-certifying. Accountants and attorneys are going to be involved in this process because there are going to be a lot of hurdles to jump through in this self-certification process. We've formed about 15 funds at this point. They're not all that difficult. The intention was to make this much easier than the New Markets Tax Program, which a lot of the legislation is based off of. But so we've got enough information to be forming these funds, and we're actively doing so now. Important to note as well, there's going to be 2 testing dates for the funds, and this is why you're going to need a strong accounting group and a strong legal group to be able to help you stay in compliance. And on a yearly basis, on June 30th and December 31st, at the fund level, at least 90% of your assets are going to need to be invested in Opportunity Zone property. And so you're going to have 2 testing dates, and you're going to have to certify to the IRS that you comply with that. And now with that, there are 2 types of investments that the fund can make. The most straightforward one is the direct investment, where the fund, which is an LLC or an LP, owns real estate. The other, or a business interest. You can invest in business as well, but we actually need a little bit more information from the IRS to really get started on the business investment side as opposed to the real estate investment side. The indirect investment approach, which we have here on the 2 outlining side, is the fund taking an interest either through a partnership interest or through a stock interest in a business that owns the real estate. So that, again, just the fund, which is an LLC or an LP, takes an equity interest into an LLC that then owns the real estate. And that indirect investment is how almost all investments, at least in real estate, are going to be done. The IRS is really pushing people toward that direction. And I'll explain in a second some of the reasons why. But so be thinking about that indirect investment approach. And then one thing I want to tell you, and this is a new revenue ruling that came out in the round of regs. This was very surprising for a number of folks, as it didn't seem like the IRS was headed in this direction. The legislation doesn't really allow for this. But when I told you that you need to substantially improve the property, you buy property for $5 million, you need to put another $5 million into developing it. We understood that to mean if you bought land in a building for $5 million, you still got to put $5 million into it. And that's what the legislation says on its face. The IRS came out with something, and they just gave an example of this. They didn't really even explain it much in the revenue ruling, but it gave the example of someone who bought land in a building for $10 million, and they did a fair market appraisal, and they attributed $6 million to the land and $4 million to the building. The IRS said they only need to improve the property by $4 million, basically their basis in the building. So that was really surprising. Of course, we work with very sophisticated and smart clients, and they started asking a lot of questions and thinking of different opportunities here. And they said, well, what if I was going to buy some vacant land for $5 million? I'd have to substantially improve that by another $5 million, and the market may not be ready for that. What if instead I told the seller before I bought it, put a $10,000 guard shack on it, I'll buy it from you, I'll improve the guard shack by another $10,000. Now I've got what amounts to a $5 million piece of property. I can put a parking lot on it, and I'm in an opportunity zone, and now I can hold this thing for 10 years, and I'll never pay any money. We think the IRS is going to view that as abusive. That sort of crosses the line as to what the program was intended for, which is to stimulate development. But if you stay within that 60-40 guideline that the IRS gave, we think that this provides a nice opportunity for acquisition rehab that may not have been available previously. So as I was telling you that this indirect investment approach is typically going to be the approach that we're going to find folks using. The reason for that is the IRS gave this safe harbor provision. So we were talking before about you've got these testing dates, and on these testing dates, you need to show that, you know, at the fund level, 90% of your assets are invested in an opportunity zone business property. The problem with that is on these two testing dates, which come every 6 months, you have to have converted cash to improvements. So for all of us that are doing real estate deals, we understand I can't substantially improve a property within 6 months and have expended all of my cash, because cash is a bad asset. That's not opportunity zone business property. So what the IRS said is if you take the indirect investment approach and you move the money from the fund down to the property level entity, you are eligible for a few different exceptions, and they are achieved by developing a written plan that says how you're intending to substantially improve the property within the next 31 months. So you've actually got an extra month now, and then have your working capital assets that are sufficient to substantially improve the property, meaning doubling your basis in that entity. That's not loan commitments. That's the funds have to actually be pushed down to the entity. So that's a nice exception that they gave, because we were really concerned as to how this would work. Now, kind of funny, everybody laughs at this one. There's a 1980s definition of sin business that's included within the description of the legislation. At some point, the IRS has got to update this, because a lot of it doesn't make a lot of sense. It says massage parlor. Does that include a massage envy if you're going to do a retail deal? One thing that a number of folks always point out is, well, marijuana is not on there. We get a lot of clients that are interested in potentially doing deals with marijuana recreationally or medically. I'd be cautious to do a deal like that, as you don't have very many, if any, federal tax deductions that you're eligible for if you are in the cannabis business. So we would certainly caution clients to be careful there if they're interested in doing that. This slide shows a little bit about sort of how the deals will typically be structured. Both your fund level, and then on the lower blue circle, that's your property level entity. So you've got a fund level entity that invests into a property or a business level entity, and then that entity owns the real estate. Both are going to have sponsors. They're both going to be multi-member entities. And then just important to note that this program allows for not just the development in real estate assets, but also the investment in businesses, whether it be opening a new business in an opportunity zone, acquiring an existing business, or relocating a business in an opportunity zone, and then expansions of businesses into opportunity zones. The program has great bipartisan support right now, which is about the only thing in Congress that does have bipartisan support. Important to note that. There are some questions that we've still got, and I can roll through some of these. There's some issues with ground leases. We've got some concerns about residential rental property. We think this is going to get resolved quickly, and by that I mean multifamily apartment or single family for rent. We're requesting through comment letters some clarification from the IRS on when and how frequently you can do refinances and take cash out of these deals. It's going to need to look like a standard real estate deal. You can't make it look like a pure loan. The original legislation had was designed to allow for what's called fund churn, where a fund could invest in property, develop it, sell it, invest in property, develop it, sell it over a 10-year period. The IRS is not allowing that to take place right now. We're optimistic it may happen, but that's probably one of the ones on this list that may not get resolved. We talked about that 60/40 ruling in terms of substantial improvement. We're waiting for the IRS to provide some additional clarifications there. There's a little bit of an issue with the multi-asset fund right now, although we've worked with clients that are developing multi-asset funds and are taking money and deploying. When you go to, under this program, when you go to sell your interest, you're actually selling the entity's interest as opposed to the asset interest. And so if you've got a multi-fund asset or multi-asset fund that, let's say, owns 10 apartment buildings, when you go to sell, you don't necessarily want to sell your entity interest. You want to sell your asset interest. And then the legislation requires that the fund acquire property and be in the active trader business. The IRS has at times interpreted that to not allow triple net leasing. We think this one's going to get resolved, and as we're working with clients right now, we're just drafting leases that have more of a property management aspect to it. The second tranche of funds were initially set to be coming in late 2018, early 2019. The government shutdown has changed things. We're expecting 4 to 6 weeks after the government's reopened to get our next tranche of legislation or regulations rather, and that should be very helpful as we continue to go through deals. But at this point, there's no reason that we're seeing not to at least get started on deals. We've got clients not only accepting money, but deploying it into real estate assets. So happy to help and answer any questions if we can be of assistance.
Hello, this is Vanessa from ARIA, and just seeing now if there's any questions. Feel free to write in the chat if there's any questions for our speakers today.
Byron, thank you so much. That was very comprehensive. That's a lot of information. That's really good.
Well, thank you for having me. I know it is not necessarily a incredibly simple program, but we think it is a program that can really work well for folks. And once you kind of grasp the basic fundamentals, I think it becomes a lot easier.
Okay, we do have our first question from Kyla Sullivan. Can you go over again why residential real estate could be a problem for an opportunity zone?
Yeah, that's a great question, and the issue is the legislation references the enterprise zone statute, and under the enterprise zone statute, and it's not uncommon in tax legislation to reference other statutes, and then effectively what that does is it pulls in pieces, sometimes more than is just referenced, but the IRS is supposed to clarify that. So in this case, the enterprise zone statute prohibits residential real estate, rental real estate, unless you have at least 20% of your gross receipts coming from commercial non-residential real estate. So in our latest comment letters to the IRS before the last round of regulations were released, we on a national working group, along with other working groups, said to the IRS, it's a little concerning that you've referenced the enterprise zone statute. Would you please clarify that this program, that you're not intending to pull in that residential restriction? Unfortunately, in the round of regs that the IRS came out with, they not only failed to clarify that, they actually made further references to the enterprise zone statute. And then in the examples that they gave, they only gave residential investment once, and it was at the fund level where we all understand the real estate isn't really going to be invested in at the fund level. It's going to be invested in at that lower tier property level. So that was really concerning for a lot of the tax community. Fortunately, the low-income housing and affordable housing lobbies are really strong and have been pounding on the IRS to fix this issue. We think it'll get fixed. This program works really well for affordable housing, and it's something we need in the United States right now. So we're optimistic. We just want to be cautious as we advise clients.
Great. I have another question from Teresa later. You talked briefly about fund contributions. What happens if someone who does not have capital gains contributes to the fund?
So they will receive all of the economic investments of the business deal, but they will receive none of the tax investments. And similarly, if someone decides to invest $1 million into the fund, but they only had $700,000 worth of gain, $700,000 will receive the tax benefits and the economic benefits, but the other $300,000 will just receive the economic benefits of the deal.
Okay, great. From Steve Hayashi, is there any map on this kind of opportunity zone available to share?
Yes, there's a great national map that a group by the name of CDFA has. And if you Google, you Google CDFA Opportunity Zone map, I think it should come up fairly quickly. And it's a good one of the United States, where you can then kind of scroll through, and it's interactive for use there. And I can try to send that out so that can be distributed to the group.
All right, we have two more last questions. The next one from Teresa again is, does the Airbnb model of short-term rentals qualify since they'd be taxed as business instead of passive?
That's a great question, and we would need to look into that. But I think you'd be able to get around that because I don't think your residential rental restriction would apply in the same fashion. I think that looks much more like a hotel.
Great. And then from Marty Lefton, as the deferral of gains thus far is only at the federal level, do you know what states have already confirmed that they will also allow benefits at the state level as well?
That is a really good question as well. There are a number of states that have done nothing, and there are 2 states in terms of what's called coupling. There are 2 states that have affirmatively said they will not couple with the federal program, and those 2 states are North Carolina and Hawaii. So in those 2 states, you will not be able to receive any of the tax benefits. That said, some of the states, Washington being one of them in which we're doing a deal, they don't have any state taxes anyway, so you wouldn't have to pay capital gains. Novogradac and Company on their website, they're an accounting group, and it's spelled Novogradac, has some really great tools, and on their website they have a list and a map of, as you go to their resources, they have a list and a map of the states that have coupled and those that have not coupled. There is some concern that California may not couple. California doesn't necessarily appear to be real tax friendly presently, but I think there's a lot of pressure here for them to couple. So we're hopeful that states like California will couple.
Thanks so much, Byron. We do still have a couple of questions coming in. I wanted to see if it's okay to share your contact info in case people want to reach out to you. Otherwise, Naveen, if you want to just wrap it up for us, thank you so much.
Yes, please do share my contact info, and you can share my slides as well. And I'm happy to chat with anybody and let us know how we can help.
Thank you, Byron.
Great. We're just going to keep up the first slide so you can catch Byron's email in case you did not get your question answered today. This webinar will be recorded and available on aria.org under resources, under webinars. We've also received permission to share the slides as well, which we appreciate, Rick and Byron.
Great. Thank you guys so much.
Thank you. Thank you again, Byron. Thank you for all your help. Vanessa, Hope, thank you again. And Jazz, thanks for putting this together for us.
Thanks.
All right. Thank you.
Take care. Have a great day. Bye.